Hey everyone, welcome back to Corporate Decoder. Ever wonder what happens when a company's only plan is to find another company? Well, today we're cracking open the financial filing of Unite Acquisition 2 Corp, a blank check company, to see if they found their match or if they're still swiping left on the stock market. This company exists solely to merge with or acquire another business. They haven't found one yet, and their financials reflect that pretty clearly. It's all expenses and no income. Think of them as a corporate cupid desperately searching for a love connection that will finally give them a reason to exist. Before we dive in, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Join us. This is their Form 10Q, which is basically a quarterly financial checkup. It tells us how they're doing every 3 months. It's like going to the doctor, but instead of your health, it's about the company's financial health. They have to file this report with the Securities and Exchange Commission, also known as the SEC. The SEC makes sure companies are following the rules and being honest with investors. This report is for the period ending March 31, 2025. Unite Acquisition 2 Corp is based in New York. It was formed in Delaware. Delaware is a popular state for companies to form in because of its business-friendly laws. The company's file number is 0005653, a number that basically is their identification to the SEC. The company has 5 million shares of common stock outstanding as of May 15, 2025. This means that there are 5 million pieces of ownership of the company out there. Let's jump into the balance sheets. Think of the balance sheet as a snapshot of what the company owns, which are assets, and what it owes, liabilities, at a specific point in time. It also shows the owner's stake in the company, which is equity. As of March 31, 2025, their total assets were $18,027. Back in December 31, 2024, they had $29,188. So they have fewer assets now. This isn't a great sign, but remember, they're a blank check company. They aren't supposed to have a lot of assets. Their total liabilities, what they owe, were $336,971 as of March 31, 2025. Back in December, it was $208. So their liabilities increased. They owe more money than they did before. The company has an accumulated deficit of $3,119,264. This is the total amount of money the company has lost since it started. Back in December, it was $257,620, so their deficit is growing. They are losing more money. Now let's look at the statements of operations. Think of it as a movie reel of the company. It captures how the company performed over a period of time. In this case, it's for the 3 months ended March 31, both this year and the prior one. Their general and administrative expenses were $53,577 for the 3 months ended March 31, 2025. Last year it was $51,295, so they're spending a bit more on these expenses. These expenses are what it costs to run the company. The company also has an interest expense of $8,137. This is the cost of borrowing money. The net loss was $61,644 in dollars for divorce 2025. In the same period last year, the loss was $51,295. So they lost more money this year. The loss per share was $0.0912. This means that for every share of stock, the company lost a little over a penny. The statement of cash flows shows how much cash the company is bringing in and spending. It's like looking at the company's bank account to see where the money is coming from and going. The company's net loss was $61,644. This is the starting point for the cash flow statement. The company used $10,981 in operating activities. This is the money they spent to keep the company running. The company had $18,207 in cash at the end of the period. The company was organized to find a target company to merge with or acquire. They are not limiting themselves to any specific business, industry, or location. They are open to anything. The company is an emerging growth company. This means they get some breaks on certain regulations. The company uses office space from its management for free. Also, they pay $1,250 per quarter for advisory, accounting, and administrative support services to Lucius Partners. This company is owned by the same people who run Unite Acquisition 2 Corp. This is a related party transaction. This basically means the company is paying its owners for services. The company has a note payable to Lucius Partners Opportunity Fund LP for $205,000. The note accrues 12% interest annually. They use the money to pay off debt to their stockholder, related party payables, and other expenses. The company says there is substantial doubt about its ability to continue as a going concern. This means that they might not be able to stay in business. They need to find an acquisition or merger candidate, raise more money, or get more loans to stay afloat. The company's cash is held in financial institutions. This means they are subject to credit risk. After March 31, 2025, the company got a loan from its sole stockholder to pay for legal and professional expenses. The company has no legal proceedings. There is no other information to report. The company's disclosure controls and procedures were not effective. This means that they didn't have a good system for making sure their financial information was accurate. The report was signed by Nathan P. Pereira, the company's Chief Executive Officer, President, Chief Financial Officer, Secretary, and Director. He's basically wearing all the hats at the company. So what's the story here? Unite Acquisition 2 Corp is burning through cash, accumulating losses, and relying on loans from related parties to stay afloat. They're desperately searching for a company to merge with, but haven't found one yet. They even admit that there's substantial doubt about their ability to continue as a going concern. Now, let's get to my take on the company. Is this a good investment? Absolutely not. It's a blank check company with no revenue, growing losses, and a going concern warning. They are completely reliant on related party transactions. The risks are obvious. They might not find a target company and run out of money. The target company might not be a good fit, and the merger could fail, and the company is small and has very limited resources. On the other hand, the opportunities are that they could find a great target company and create a successful merger. They have the potential to create value for investors, but this is a very high risk, high reward situation. Overall, the company is weak. They are losing money, have a lot of debt, and are not generating any revenue. I would advise investors to stay away from this company. Alright, that's our breakdown of Unite Acquisition 2, Corp's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.